Let's compute the ratios which I initially discussed. Profitability. The following ratios may be used to evaluate the profitability of the business: return on ordinary shareholders' funds, return on capital employed, operating profit margin, and gross profit margin. We shall look at each of these one by one. The return on ordinary shareholders' funds ratio compares the amount of profit for the period available to the owners with the owner's average stake in the business during that same period. The ratio, which is normally expressed in percentage terms, is as follows. The profit for the year, less any preference dividend, is used in the ratio, as it represents the profit attributable to the owners. In the case of Alexis Company, applying the formula reveals that the return on ordinary shareholders' funds ratio for the period ending March 31, 2019 is 2%. Generally, businesses seek to generate as high a value as possible for this ratio. This is provided that it is not achieved at the expense of potential future returns, for example, by taking on more risky activities. The 2019 ratio of 2% is very poor against any standard. A bank deposit account might yield a better return without the company doing nothing. With this ratio known, we need to try to find out why things went so badly wrong in 2019. As we look at other ratios, we should find some clues. The return on capital employed ratio, or ROCE, is a fundamental measure of business performance. This ratio expresses the relationship between the operating profit generated during a period and the average long-term capital invested in the business. Alexis Company has a 5.9% return on capital employed. This ratio tells much the same story as return in shareholders' funds, a poor performance, with the return on the capital employed being less than the rate that the business has to pay for most of its borrowed funds. That is, as you can see here, 9% for the loan notes. The operating profit margin ratio relates the operating profit for the period to the sales revenue. The ratio is expressed as follows. Operating profit, that is, profit before interest and taxation, is used in this ratio as it represents the profit from trading operations before the interest payable expense is taken into account. It is normally the most appropriate measure of operational performance when making comparisons. This is because differences arising from the way in which the business is financed will not influence the measure. This ratio compares one output of the business, operating profit, with another output, sales revenue. The ratio can vary considerably between different types of business. Supermarkets, for example, tend to operate on low prices and therefore low operating profit margins. This is done in an attempt to stimulate sales and thereby increase the total amount of operating profit generated. Jewelers, on the other hand, tend to have high operating profit margins but have much lower levels of sales volume. Factors such as the degree of competition, the type of customer, the economic climate, and industry characteristics such as the level of risk will influence the operating profit margin of a business. For Alexis Company, the operating profit margin is 1.8%. Once again, this is a very weak performance compared with that of 2018 with a ratio of 10.8%, which means that in the previous year, for every 1 pound of sales revenue, an average of 10.8 cents was left as operating profit, after paying the cost of the carpet sold and other expenses of operating the business. By 2019, however, this had fallen to only 1.8 cents for every 1 pound. The reason for the poor ROSF and ROCE ratios appears to have been partially, if not wholly, due to a high level of expenses relative to sales revenue. The next ratio should provide us with a clue as to how the sharp decline in this ratio occurred. The gross profit margin ratio relates the gross profit of the business to the sales revenue generated for the same period. Gross profit represents the difference between sales revenue and the cost of sales. The ratio is therefore a measure of profitability in buying or producing and selling goods or services before any other expense are taken into account. As cost of sales represents a major expense for many businesses, a change in this ratio can have a significant effect on the bottom line, that is, the profit for the year. The gross profit margin ratio is calculated as follows. Applying the formula for Alex's company, we will get 15.3%. If you will compute for 2018, you will get 22.1%. Keeping in mind that gross profit is sales revenue less cost of sales or cost of goods sold, this means that cost of sales was higher relative to sales revenue in 2019 than in 2018. This could mean that sales prices were lower and or that the purchase cost of carpets sold had increased. It is possible that both sales prices and purchase costs had reduced, but the former at a greater rate than the latter. Similarly, they may both have increased, but with the sales price having increased at a lesser rate than the cost of the carpets. Clearly, part of the decline in the operating profit margin ratio is linked to the dramatic decline in the gross profit margin ratio. Whereas, after paying for the carpet sold, for each 1 pound of sales revenue, 22.1 cents was left to cover other operating expenses in 2018, and this was only 15.3 cents in 2019. With the profitability ratios computed, we can see that the decline in the operating profit margin was 9 percentage points. That is, from 10.8% to 1.8%, whereas that of the gross profit margin was only 6.8 percentage points. That is, from 22.1% to 15.3%. This can only mean that operating expenses were greater compared with sales revenue in 2019 than they had been in 2018. The decline in both ROSF and ROCE was caused partly, therefore, by the business incurring higher inventories purchasing costs relative to sales revenue and partly through higher operating expenses compared with sales revenue. We need to compare each of these ratios with their planned level, however, before we can usefully assess the business's success. Efficiency ratios are used to try to assess how successfully the various resources of the business are managed. The following ratios examine some of the more important aspects of resource management: average inventories turnover period, average settlement period for trade receivables, average settlement period for trade payables, sales revenue to capital employed, sales revenue per employee. We shall now look at each of these. Average inventories turnover period. Inventories often represent a significant investment for a business. For some types of business, like manufacturers and certain retailers, inventories may account for a substantial portion of the total assets held. The average inventories turnover period ratio measures the average period for which inventories are being held. The ratio is calculated as follows. The average inventories for the period can be calculated as a simple average of the opening and closing inventory levels for the year. In the case of a highly seasonal business, however, where inventory levels may vary greatly over the year, a monthly average would be better. Such information may not, however, be available. This point concerning monthly averaging is equally relevant to any asset or claim that varies over the reporting period and would include trade receivables and trade payables. Alex's company's average inventories turnover period is 56.7 days. If you will compute the previous year's figures, you'll arrive at 56.6 days. Thus, the inventory's turnover period is virtually the same in both years. Average settlement period for trade receivables. Selling on credit is the norm for most businesses, except for retailers. Thus, trade receivables must be accepted as a necessary evil. A business will naturally be concerned with the amount of funds tied up in trade receivables and try to keep this to a minimum. The speed of payment can have a significant effect on businesses' cash flow. The average settlement period for trade receivables ratio calculates how long, on the average, credit customers take to pay the amounts that they owe to the business. The ratio is as follows. A business will normally prefer a shorter average settlement period to a longer one, as, once again, funds are being tied up that may be used for more profitable purposes. Although this ratio can be useful, it is important to remember that it produces an average figure for the number of days for which debts are outstanding. This average may be badly distorted by, for example, a few large customers who are very slow or very fast payers. Since all sales made by Alexis Company are on credit, the average settlement period for trade receivables for the year ended March 31, 2019 is 34.9 days. In 2018, it had 37.7 days. This reduction in the settlement period is usually favorable. It means that less cash was tied up in trade receivables for each £1 of sales revenue in 2019 than in 2018. Only if the reduction were achieved at the expense of customer goodwill or through high out-of-pocket cost might its desirability be questioned. For example, the reduction may have been due to chasing customers too vigorously or to giving large discounts to customers for prompt payment. Average settlement period for trade payables. The average settlement period for trade payables ratio measures how long, on the average, the business takes to pay those who have supplied goods and services on credit. The ratio is calculated as follows. This ratio provides an average figure which, like the average settlement period for trade receivables ratio, can be distorted by the payment period for one or two large suppliers. As trade payables provide a free source of finance for a business, it is not surprising that some businesses attempt to increase their average settlement period for trade payables. Such a policy can be taken too far, however, and result in a loss of supplier goodwill. For the year ended March 31, 2018, Alexis Company's average settlement period for trade payables is 47.2 days. In 2018, it was 44.9 days. There was an increase between 2018 and 2019 in the average length of time that elapsed between buying goods and services and paying for them. On the face of it, this is beneficial because the business is using free finance provided by suppliers. This may not be so, however, where it results in a loss of supplier goodwill and Alexis Company suffers adverse consequences. Sales revenue to capital employed. Sales revenue to capital employed ratio or net asset turnover ratio examines how effectively the assets of the business are being used to generate sales revenue. It is calculated as follows. Generally, a higher sales revenue to capital employed ratio is preferred to a lower one. A higher ratio will normally suggest that assets are being used more productively in the generation of revenue. A very high ratio, however, may suggest that the business is overtrading on its assets. In other words, it has insufficient assets to sustain the level of sales revenue achieved. When comparing this ratio for different businesses, factors such as the age and condition of assets held, the valuation basis for assets, and whether assets are leased or owned outright can complicate interpretation. A variation of this formula is to use the total assets less current liabilities in the denominator. An identical result is obtained. For the year ended March 31, 2019, this ratio for Alexis Company is 3.36 times. This seems to be an improvement from 2018's 3.20 times, since in 2019, more sales revenue was being generated for each £1 of capital employed than was the case in 2018. Provided that overtrading is not an issue and that the additional sales generate an acceptable profit, this is to be welcomed. Sales revenue per employee. The sales revenue per employee ratio relates the sales revenue during a reporting period to a particular business resource, that is, labor. It provides a measure of the productivity of the workforce. The ratio is sales revenue divided by the number of employees. Generally, businesses would prefer a high value for this ratio, implying that they are deploying their workforce efficiently. For Alex's company, the ratio for 2019 is 143,962 per employee, meaning every employee, on the average, generates 143,962 pounds. If you will compute the 2018 figure, you'll get 160,057. And this represents a fairly significant decline, which merits further investigation. As mentioned previously, the number of employees increased significantly by about 33% during 2019. We need to know why this has not generated sufficient additional sales revenue to maintain the ratio at its 2018 level. It may be because the extra employees were not appointed until the year ended March 31, 2019. With the efficiency ratios computed, we can infer that maintaining the inventory's turnover period at 2018 level might be reasonable, although we need to know the planned inventory period to make a proper assessment. The inventory turnover period for other businesses operating in carpet retailing, particularly those regarded as the market leaders, may have been helpful in formulating the plans. On the face of it, a shorter trade receivable settlement period and a longer trade payable settlement period are both desirable. However, this may have been achieved at the cost of a lost goodwill among customers and suppliers, respectively. The increased sales revenue to capital employed ratio seems beneficial provided that the business can manage this increase. The decline in sales revenue per employee ratio is undesirable, but is probably related to the dramatic increase in the number of employees. As with the inventory's turnover period, these other ratios need to be compared with planned or target ratios. Now let's proceed to liquidity ratios. Again, liquidity ratios are concerned with the ability of the business to meet its short-term financial obligations. The widely used ratios are the current ratio and the acid test ratio. The current ratio compares the liquid assets, that is, cash and those assets held that will soon be turned into cash, with current liabilities. The ratios is calculated by dividing current assets by current liabilities. There seems to be a belief that there is an ideal current ratio, usually 2 times or 2:1 for all businesses. However, this is not the case. Different types of business require different current ratios. A manufacturing business, for example, will often have a relatively high current ratio because it has to hold inventories of finished goods, raw materials, and work in progress. It will also sell goods on credit, thereby giving rise to trade receivables. A supermarket chain, meanwhile, will have a relatively low ratio as it will hold only fast-moving inventories of finished goods and its sales will be for cash rather than on credit. The higher the current ratio, the more liquid the business is considered to be. As liquidity is vital to the survival of a business, a higher current ratio might be thought to be preferable to a lower one. If a business has a very high ratio, however, it may indicate that excessive funds are tied up in cash or other liquid assets rather than being employed more productively. For Alex's company, the current ratio as of March 31, 2019 is 1.6 times, meaning current assets is 1.6 times bigger than its current liabilities. In 2018, it was 1.9 times. Although there is a decline from 2018 to 2019, this need not be a cause for concern. The next ratio may provide a clue as to whether there seems to be a problem. The acid test ratio is similar to the current ratio but provides a more stringent test of liquidity. For many businesses, inventories cannot be converted into cash quickly. Note that in the case of Alexis' company, the inventory's turnover period was about 57 days in both years. As a result, there is a good case for excluding this particular asset. The acid test ratio is calculated the same as the current ratio, except that the numerator shall now exclude the amount of inventories. The 2019 ratio of 0.6 times is significantly below that of 2018's acid test ratio of 0.8 times. The 2019 level may well be a source of concern. The rapid decline in this ratio should be investigated and, if necessary, corrective action should be taken. The minimum level for this ratio is often stated as 1.0 times. For many highly successful businesses, however, it is not unusual for the acid test ratio to be below 1.0 without causing liquidity problems. With the current ratios computed, we can deduce that both ratios indicate a decline in liquidity from 2018 to 2019. This decline, however, may be planned, short-term, and linked to the increase in non-current assets and the number of employees. When the benefits of the expansion come on stream, liquidity may improve. On the other hand, short-term lenders and suppliers may become anxious when they see signs of weak liquidity. This could lead them to press for payment, which could cause problems for Alex's company. Financial gearing. Financial gearing occurs when there is a borrowing within the capital structure of a business. The existence of financial gearing can affect the risks and returns to ordinary shareholders. In order to measure the level of gearing, two ratios are widely used. They are the gearing ratio and the interest cover ratio. The gearing ratio measures the contribution of long-term lenders to the long-term capital structure of business. The gearing ratio of Alexis' company as of March 31, 2019 is 36%. In 2018, it had 26.2%. This means that there is a substantial increase in the level of gearing or long-term financing over the year. So there was a significant reliance in long-term borrowing. The interest cover ratio measures the amount of profit available to cover interest payable. In 2018, it was 13.5. This ratio shows that the level of operating profit in 2018 was considerably higher than the level of interest payable. This means that a large fall in operating profit could occur before operating profit levels failed to cover interest payable. The lower the level of operating profit coverage, the greater the risk to lenders that interest payments will not be met. There will also be a greater risk to the shareholders that lenders will take action to recover the interest due. For 2019, interest cover ratio for Alex's company is 1.5 times. So there was a material decline. Interest cover ratios vary considerably between industries. They also vary between companies within the same industry. With these ratios, we can deduce that the reliance to long-term debt has changed significantly. The gearing ratio at March 31, 2019 would not necessarily be considered to be very high for a business that was trading successfully. It is the low profitability that is the problem. The interest cover ratio has declined dramatically from 13.5 times in 2018 to 1.5 times in 2019. This was partly caused by the increase in borrowings in 2019, but was mainly caused by the dramatic decline in profitability in that year. The situation in 2019 looks hazardous. Only a small decline in future operating profit would leave the business unable to cover its interest payments. Without knowing the planned ratios, it is not possible to reach a firm conclusion on Alexis company's leverage. Various ratios are available to help shareholders assess the returns on their investment. The following are widely used: dividend payout ratio, dividend yield ratio, earnings per share, and price to earnings ratio. The dividend payout ratio measures the proportion of earnings that a business pays out to shareholders in the form of dividends. In the case of ordinary shares, the earnings available for dividend will normally be the profit for the year. That is, the profit after taxation, less any preference dividends relating to the year. This ratio is normally expressed as percentage. The dividend payout for Alexis Company for the year ended March 31, 2019 is 363%. This reveals an alarming increase in the ratio over the 2 years. Paying a dividend of 40 million in 2019 appears to be very imprudent. The information provided by the above ratio is often expressed slightly differently as the dividend cover ratio. It is actually the reciprocal of dividend payout ratio, and Alex's company obtained 0.3 times in 2019. That is to say, the earnings available for dividend covered the actual dividend paid by just 0.3 times. In 2018, it was 4.1 times. Next, the dividend yield ratio. This relates the cash return from a share to its current market value. This can help investors to assess the cash return on their investment in the business. The ratio is expressed as a percentage. For 2019, Alex's company has 4.5% dividend yield, while in 2018, it has 2.7%. Although the increase is seemingly attractive, it is caused by the dividend payout which was made despite the decrease in financial performance. Earnings per share. The earnings per share ratio relates the earnings generated by the business and available to shareholders during a period to the number of shares in issue. For ordinary shareholders, the amount available will be represented by the profit for the year, less any preference dividend, where applicable. Many investment analysts regard the EPS ratio as a fundamental measure of share performance. The trend in earnings per share over time is used to help assess the investment potential of a business's shares. Although it is possible to make total profit increase through ordinary shareholders investing more in the business, this will not necessarily lead to an increase in the profitability per share. For the year 2019, Alex's company's earnings per share is 1.8 per share, while in 2018 it was 27.5 per share. It is not usually very helpful to compare EPS of one business with that of another. Differences in financing arrangement, for example in the nominal value of shares issued, can render any such comparison meaningless. However, it can be very useful to monitor the changes that occur in this ratio for a particular business over time. Then price to earnings ratio. The price to earnings or price earnings ratio relates the market value of a share to the earnings per share. This ratio can be calculated by dividing the market value per share by earnings per share. In 2019, Alex's company's price earnings ratio is 83.3 times, from 2018's ratio of 9.1 times. Note that we already obtained the value of earnings per share in the previous slides. The ratio indicates that the market value of the share is 83.3 times higher than its current level of earnings. It is a measure of market confidence in the future of a business. The higher the price earnings ratio, the greater the confidence in the future earning power of the business, and consequently, the more investors are prepared to pay in relation to that current earning power. As price earnings ratios provide a useful guide to market confidence about the future, they can be helpful when comparing different businesses. However, differences in accounting policies between businesses can lead to different profit and earnings per share figures. This can distort comparisons. Now, with these ratios known, we can infer that although the EPS has fallen dramatically and the dividend payment for 2019 seems very imprudent, the share price has held up reasonably well. Moreover, the dividend yield and price earnings ratios have improved in 2019. This is an anomaly of these two ratios, which stems from using a forward looking value, the share price, in conjunction with historic data, the dividends and earnings. Share prices are based on investors' assessments of the business's future. It seems that the market was less happy with Alexis' company at the end of 2019 than at the end of 2018. This is evidenced by the fact that share price had fallen by £1 a share. The decline in share price, however, was less dramatic than the decline in profit for the year. This suggests that investors believe that the business will perform better in the future. Perhaps they are confident that the large increase in assets and employee numbers occurring in 2019 will yield benefits in the future, benefits that the business was not able to generate during 2019. So, that is an example of financial statement analysis. With it, you will be able to pinpoint or narrow down what the problem of the company could be. And so, you will be able to solve for the actual problem. As in case studies, you need to properly identify the problem first and then solve it.